thank you very much for joining this evening. Thank you for your interest in Henderson European Focus Trust. There's a 48-slide presentation of which I promise I will only go through a handful, but you'll get the benefit of the full slide deck on Henderson European Focus Trust sent round afterwards. In the next 15 minutes, I'd like to just give a high-level overview and leave some time for questions. And of course, as always, welcome any follow-up after this presentation. So, quick introduction to Henderson European Focus Trust. Listed in London, it's a portfolio of predominantly large-cap European equities. We purchase up to a maximum of 45 stocks, so it's quite focused. The net assets of the fund are just over £320 million at the moment. It's been managed by my boss, John Bennett, since 2010. It's a very long tenure, and it's been co-managed by me since 2020. As I mentioned, we invest in mainly large, globally diversified companies that happen to be born in Europe. And importantly, especially at a time like this, we're style agnostic. So we do not take a dogmatic view over the type of investment philosophy we should pursue. So we don't just invest in, let's say, very high growth technology companies. Conversely, we don't just invest in the cheapest stocks out there. Style agnostic, that's what we are. That is a philosophy in itself, to be fair. Given all of the doom and gloom out there, I thought it would be worth just reiterating the case for equities. Obviously, stock markets have sold off year to date. The European index is down about 15%. Not ideal, of course, but the backdrop is very, very high levels of inflation. And as you can see from this chart, this is showing that we're heading towards double-digit inflation already in the Western world. Which you have to go back a very long way to remember a time that's happened before. Indeed, being only 25 years old, I wasn't born at that point. I'm not 25. I'm a bit older than that. The forecasts are for even more doom and gloom, especially in the UK. So you see Goldman Sachs and Citigroup. They're all competing to give the scariest number for next year. So we're looking at maybe 18% inflation, even 22% inflation by early next year. That is an environment in which you need to seriously consider owning equities, because yes, stock markets can be volatile in the short term. Selectively choosing equities, I should add. Not every equity is a surefire hedge against inflation. You need to be selective, and of course that's what we do as a team of stock pickers. What are good inflation hedges in equity land? Well, good companies that can pass on that inflation in the prices of their products and services. So compared to having cash in the bank at a time like this, when your interest rate will get absolutely nowhere near the rates of inflation we're likely to see, equities are something that should be seriously considered, and indeed I do practice that myself in my own savings. The other thing that we should consider here as UK investors, and HEFT being a UK listed vehicle, is that we should also be thinking about diversifying at least part of our savings, part of our wealth away from sterling. And I say that on a day when sterling has actually just hit the lowest level against the US dollar in 37 years. So it's bumpy out there. Diversification is an important tool in which to preserve and grow your capital. So if that's the case for equities, well, what's the case for European equities? That's the next hurdle that we need to tackle. And I mentioned at the beginning that we are invested predominantly in large cap European equities. So the thing that we need to remember here is, yes, European politics are shambolic to an extent. It's always been the case. There's some scary things going on right now, of course, because we're being held to ransom in terms of our energy supply. But European politics isn't the European stock market. And then you can go one step further and say large cap Europe, which HEFT predominantly invest in, that is not the European stock market. It's not European politics. There are opportunities to own globally diversified champions. And so a little bit about how we invest in European stocks. Two approaches to stock picking I'm going to talk about, and then I'm going to come on to one of our big current sector calls, which is the oil industry. This stock is very heavily invested in oil and gas. So for those of you that absolutely do not agree with that on moral grounds, I fully respect that decision, but you may not want to listen to the rest of this presentation. Maybe you should, because maybe we can change your mind about why they are both morally and, more importantly for us from a financial standpoint, important investments in our fund right now. But first, onto the two components of bottom-up stock picking that we take. First of all, following on from the point about large cap, high quality European companies, we will pay for good quality companies. We'll pay a fair price for those. And this screen here shows what we call franchise stocks, which is a bit of an odd term, but basically it's because our compliance department wouldn't let us call them growth stocks, because that has some sort of suggestive advisory component to it. But basically these are companies that demonstrate higher rates of growth than GDP, and they are founded on strong economic moats, to use a Warren Buffett term. These are stocks that have unique IP. So if I take their ASML is the global champion of manufacturing equipment for the semiconductor industry. So the IP embedded within that Dutch listed company is pretty incredible. That means the stock doesn't come cheap, but it's so unique, we will pay for that. Likewise, Novo Nordisk, global leaders in the treatment of diabetes and obesity. And excuse the pun, but that really is a growth area. Again, the IP possessed by Novo Nordisk is incredible. And then there are other forms of economic moats. If we take something like brand equity, LVMH, they're owners of the Louis Vuitton brand. That is a brand, again, with incredibly strong global brand equity, and that gives pricing power. Now, it's important just to reiterate, we are style agnostic. So we're not ardent value seekers. We don't just buy the cheap stuff, but equally we care about the price we pay for things. And that's the context I wanted to add for this particular slide. We're always very careful not to follow the hype, because that tends to mean that you overpay for things. You won't hear John and myself preaching about investing in disruptors, flywheel business models, cryptocurrencies, or the metaverse. Again, if that's your bag, we're probably not for you. We're not quite that sexy. Next slide. We also like looking for change. So on the previous slide, I talked about how we will pay up for good quality companies. There are also always opportunities to invest in improving companies that we think are on the way to becoming good companies. This can be as a result of management change or portfolio change. And the European stock market always throws up these opportunities because actually it's an index that contains a lot of legacy businesses, things that have been around a long time. And the chances are there are always a few of them that have fallen by the wayside and fallen out of favor. And these are really good opportunities for creating shareholder value, because if a new management team comes in, they can make the necessary portfolio changes, they can improve earnings by reducing costs, by fueling, by reallocating resources to the growth areas of the company. And so you get the potential of earnings accretion, but that also usually corresponds to the market being willing to pay a higher price for those earnings too. So you get the dual effect of higher earnings and a higher multiple on those earnings. So we love looking for change. We don't like value in a vacuum, let's say. Of course, sometimes you do fall into those value traps, but by and large, we're confident in our ability to find change at a cheap and attractive price. Finally, in terms of the shape of the portfolio, and just before I come on to oil, I'll take a look at this slide with you. And this is the broad sector allocation of the fund. The orange bars are the percentage of HEFT with it allocated to these sectors, and then the black bars are how much these sectors account for the benchmark. And what I really want to draw your attention to here, other than broad diversification, is the second orange bar from the top. That is our exposure to oil and gas. You'll notice that the orange bar is miles bigger than the black bar. And that's because we've taken what I believe is, it certainly was, but I believe certainly still is, a very differentiated view on the value of oil within an equity portfolio. So this is our biggest overweight in the fund. The fund in total has about 18% in oil and gas, predominantly the oil majors. So those names that you'll have all heard of: Total Energies, Shell, BP, and then also a smaller company called Aker BP, formerly Lundin Energy. They add up to about 18% of the fund. Why do we like them? Why do we think that they are an important allocation for HEFT at this point in time? Well, as a little bit of a potted history, over the last 5 to 10 years, the stock market's effectively cancelled oil. You've had obviously a lot of noise in the media, in social media, from governments themselves about the moral, the questionable moral aspect to owning oil and gas equities. And the result of that has been, it's led to the stock market, the term derating these companies. These stocks have got cheaper and cheaper in terms of their actual earnings. And this actually fed through to the way oil and gas companies allocate their capital. They stopped investing in upstream oil and gas capacity because they felt vilified, effectively. And about 12 months ago, just as a quick anecdote, I had a call with the CEO of Shell, but he was saying his daughter was being bullied because her dad was the CEO of big, bad, evil Shell. That's going to feed through into the psychology of even the management team and the boards of these oil companies, and it did. So they effectively underinvested, and this happened on a global basis. And right now, what we can see in the oil and gas market is we're beholden to unreliable partners. I think that's the term that the German politicians have been using in terms of on a country basis. But there's essentially a shortage. There's an imbalance between supply and demand for oil. So the medium-term prospects for oil prices and for the earnings of these oil majors that have really been focusing in on not growing their oil volumes, but actually making sure the volumes that they do extract are the lowest possible cost. It means that the earnings profile of the oil sector looks very, very strong, we think. And despite this, the stocks are still incredibly cheap. You know, they're priced for death within 5 to 10 years in many cases. You know, Shell is basically trading on a multiple of about 5 to 6 times its annual free cash flow, which implies that it's priced for oil either being much lower than it is now, which we don't believe because we think there's a supply and demand imbalance, or it basically ceasing to exist because it exhausts all of its resources in the next 5 to 10 years. Now, neither of those scenarios make sense to us. So these are cheap stocks, and that's despite entering, we could term it the era of energy security. It's top of the political agenda, isn't it? Just Liz Truss, she's only been in the door 24 to 36 hours, but she's already having her premiership defined by what she's saying about energy. So whether that's capping household bills or whether it's allowing fracking to take place so that the UK can enhance its own energy security. The era of energy security is here, and it's probably not going to go away very quickly, even if we think there's a ceasefire in Ukraine. It'll take a long, long time for the European community to start trusting Russia again. Finally, look, we think oil majors have been dealt a poor hand in terms of their perception. They have a pivotal role to play in the energy transition. They're here to keep the lights on right now, but they also all have vast amounts of cash that they can invest into clean technologies. They all have already significant portfolios of wind energy, solar energy, and of course they have all of the engineering and scientific expertise in-house to be able to feed into the energy transition effectively. Now, on top of that, the management teams are demonstrating strong financial discipline, so they're committing to paying out significant amounts of this cash flow in dividends and buybacks. And just going back to the point I made on inflation and how we need to think very carefully about that now, because it's here and it's likely to stay at a higher level than it has been historically. What's also been de-emphasized in recent years, while we've been arguing over the morality of owning oil and gas shares, is that effectively we think that the people who abandoned this sector on environmental grounds will probably change their tune. And in fact, we're already seeing that. We're seeing ESG funds starting to shift the goalposts a bit in terms of their investment policies and the restrictions that they place on their own investments. So that's oil. That's where we are now. Top 10 holdings in the fund, again, just highlights. Shell is there at number 1, over 6%. Lundin Energy, now called Aker BP, nearly 6%. You look down the list, you've got Total Energies, you've got then some of those global champions I mentioned, Novo Nordisk, diabetes and obesity treatments, LVMH, Louis Vuitton. So we've got a very strong diversification of strong, good quality, idiosyncratic stocks, and then we've got our high conviction view on the oil and gas sector. Just to finish up before we go to Q&A, a bit about performance. This is the long-term performance of HEFT. If you look on a 10-year basis, the fund's up over 200%. The benchmark's up 153%, so strong outperformance there. But again, actually, it's worth highlighting that you would have got nowhere near that return keeping cash in the bank over the last 10 years. And again, with inflation back in a way that we've not known for at least a generation, equities are something that we really need to think about in terms of preserving and growing our capital. Now, on a 1-year basis, this number's as at the end of June, slight underperformance versus the benchmark. Actually, June was a difficult month for us because our oil and gas exposure was weak. Recession concerns fed into the market, and then concerns about demand destruction in oil and gas led these shares to sell off somewhat. We used that opportunity to buy more. The beauty of HEFT as a closed-ended investment fund is we can use leverage to our advantage, and actually we we borrowed long-term 25 to 30-year debt at a very low cost of interest in January in anticipation of being able to use it when we have high conviction over something. And we've not used it a huge amount, through the war hitting and the months after that. When we had the sell-off in oil and gas in June, we deployed the leverage to take our exposure to oil and gas higher, and that's when we arrived at 18%. And I'm pleased to say that in the months since that, the performance of the fund has been better. So on a one-year basis now, if you'd look today, we'd be somewhere in the region of 150 to 200 basis points ahead of the benchmark. With that, I will pause and invite any questions.
A number of questions about politics and oil and gas companies in Europe. So now combining the kind of the lot of them in kind of the overall theme. I guess it's kind of your thoughts on the risks of nationalisation at the extreme or windfall taxes on the oil and gas companies.
Yeah, it's a great question, and it's a hot topic, of course, in energy markets more broadly at the minute. Simply, it's very, very hard for one single country to impose a meaningful windfall tax on a global oil and gas company. And it goes back to that point I mentioned earlier. We're invested in, they may be listed or born or live in Europe from a headquarter perspective, but they're globally diversified. Now, first out of the traps, pre-Liz Truss was the UK. Labour were banging the drum about a windfall tax on those evil oil giants, and they're making billions. The problem is those billions are not coming from the UK. The UK's North Sea is a very, very small contribution to the earnings of Shell, Total, a bit more for BP, but it's basically tiny. And actually, in a more recent call with the Shell CEO, he said, there's nothing to tax for us in the North Sea because we made a loss last year anyway. It's tiny. So unless there was a globally coordinated agreement to hammer these oil and gas majors, it's very unlikely. And one other anecdote that I think is well worth sharing here was a recent meeting with the Shell chairman, a guy called Andrew Mackenzie, who was formerly the CEO of BHP Billiton. So he's very well experienced at running large global multinational commodity companies where there's always a political angle. He said the government on the one hand is saying we must remove ourselves from reliance on oil and gas and remove ourselves from Russian oil and gas. And then they're picking up the phone to Shell and BP and saying, don't go too quickly because we need it. We need to keep the lights on. The electorate will not forgive us if the lights go out. So they're out in the open. There's a tendency to say these are big evil companies, they're making too much money, but behind closed doors, the politics is now fully in favor of partnering with these companies. It's important to remember that the listed oil majors, they only account for about 25% of global oil and gas supply. The rest is your big national oil companies that form part of OPEC. So the listed guys, the Western listed accountable guys, they're the reliable ones. They're the good guys. So you don't want to bash them too much, basically, and force them to switch off the taps and not invest. You want them to invest. So I think there's a small risk, and I think that's why a lot of these governments moved on to directly considering energy or electricity generation, because they are more domestic companies. It's SSE in the UK, it's RWE in Germany. They can basically more easily pick a fight with those guys. They sort of gave up on the oil and gas companies because no one country is important enough for the earnings profile.
Thank you. Question about just again a clarity on the fund is ex-UK. You mentioned a BP, but it's not the same BP that people might be thinking of. What's the split by exchange?
Split by exchange. So it's all continental Europe, with the exception of at this point Shell. We use the London line because it's a bit more liquid. We can use the Netherlands line, but we choose to use the London line, BP, the London line, and also Glencore. Glencore obviously is global commodities. It's coal, which has become increasingly valuable in an era of energy shortage, but also it's the biggest global miner of electronic vehicle battery materials, so copper, cobalt. They're all London listed. Importantly, we are ex-UK, but we are selectively able to buy stocks listed outside of continental Europe if they derive a meaningful amount of their earnings from Europe. And of course, Europe is a big chunk of the global economy. Shell, BP, Total all have big refining assets in Europe, so they're meaningfully European companies from an earnings perspective.
Thank you. Next question: Does the fund use currency hedging?
No currency hedging.
Next question: dividend. What's the current dividend, and what's the dividend policy?
The dividend policy. So I think at the minute the dividend yield will be in the region of, not checked today, something like 2.5%, 2.7%. The dividend policy is to be progressive, and in our half-year report, we lifted the interim. Part of that is to rebase. We want to be a little bit more balanced in how we do interim and final. What I can say is, based on the companies in the portfolio, that there's been some special dividends received this year because certain companies have divested, gone through M&A. So the income profile of the fund is really quite strong at this point in time. Now, of course, you never know what can happen, right? If there's a severe recession, then income from stocks can go down. So we're always careful to make sure that we pursue a progressive policy, but in a way that doesn't leave us on the hook for requiring a certain macroeconomic outcome. So the dividend policy is we are not an income fund, so you will be able to find a higher dividend yield from other trusts. We're much more total shareholder return focused. So we pursue both capital growth and income plays a role in that. So TSR is what we pursue. But yeah, at the minute, the income attributes of HEFT are pretty good too.
Time for one more question. There's been quite a few I'm afraid I haven't got time for, but on that theme, special dividends, capital used by companies, we've seen a lot of buybacks in the UK. Is that same activity happening in continental Europe, or is there a different philosophy?
Yes, it is happening. It is happening. Many stocks. Certainly the stocks that are, I guess, on a very broad brush basis, they might be the more industrial or macro sensitive stocks. Share prices have come off. The market will shoot first and ask questions later when there's a bit of nervousness around. Many of these companies, especially the ones we invest in, because we don't invest in highly levered companies, many of them have seen fit to buy back stock. But I have to say, none of them are doing it on the scale of the oil and gas companies right now. I mean, that is staggering. And it reminds me of, I used to be on the sell side for about 10 years, covering the mining sector. And the mining sector, very similar to oil and gas, global commodity, all of that stuff. They had a near-death experience in late 2015. They scrapped their progressive dividends. Glencore did a rights issue. They all had to focus on delevering. The market, from a macro perspective, turned in their favor again. They started to delever really quickly. And now if you look today, the legacy of that is the mining sector is basically net cash and pays out monster dividends and buybacks. That's where we are right now with the oil sector, but a bit earlier in the process, in my view.